Hello, we're going to go back and start another session that we've got going for today. So it's good to have you here. For those of you who are joining me live, if you will go ahead and put your questions either in the Q&A or over in the chat, then I'll be circling back to those at the end. Now, it's good to have you here. I'm Amy Rose Herrick, and I am America's Profit Building Specialist. I've been asked to put together some sessions that we can do together to help educate you on some individual topics. And that's what we're going to be doing today. And then in addition to that, there are separate classes that are for entrepreneurs. So any of you who really like to learn and have some things that you'd like to learn, this is your opportunity. There will be additional classes that are put up, and you'll be able to see those on my Facebook events calendar is one place that those will be available. If you have additional topics, please put them in. I can make sure that you're aware of those classes. So we're going to go ahead and get started because I know that our time is valuable. So let's do some screen share here. And we're going to go ahead and get started. Now you'll be able to see me, of course, off to the side as we go through here. What I try to do is answer some of your questions at the tail end. Well, today we're going to talk a little bit about finances 101. And really, I'm going to do a very quick overview of a lot of different topics, but this is to get some of the conversation started and also to give you some tools that you can work with after class is over. So again, please put some of your questions and comments in, and I'll be able to circle back to those a little bit later. I always give a real quick disclosure. You know, these are general concepts, but I would expect you to speak to a financial professional, an attorney, tax advisor, someone along those lines. If you don't have somebody you're working with, then reach out to me and we'll see if I can't be of help and service to you. Now, I have a wide variety of audiences that watch this. So I'm going to talk a little bit at first about adulting. You know, what is adulting? Well, when you're adulting, you have a whole new set of skills. And adulting doesn't matter if you're 18 or 28 or 88. These are all things that we have to do. So we have work relationships that we're working with. You've got relationships that can be marriage, divorce. They could be cohabitating. They're your work relationships. Some of us have children. Some of us have one. Some of us have a lot more than that. Some of us have aging parents that we're working with, so our issues can go across multiple generations. What about your legal responsibilities? Well, nobody likes to talk about those type of documents. You know, how many of you, if we're putting our hand up, how many of you have a will? You know, nobody's going to see you at this point. How many of you have a will? How about a living will or a medical directive? What about a power of attorney? Medical power of attorney? How many of you have loans, mortgages? What about credit cards? Do you have bank accounts? All of these things go along with some of your legal documents and responsibilities. Taxes. Probably the least favorite topic that we go over at times are taxes, but most of us pay them. And you know, you really have a choice. You can pay the highest amount of tax due, or you can pay the lowest amount of tax due. And much of that goes along with how you structure your assets and how you do some of your planning year to year. So again, working through some of these classes, I'd like to open your mind a little bit, maybe to some ideas that you haven't discussed before, or questions that you really didn't know that you needed to ask. So I'm going to start with the 28% rule. Well, the 28% rule is very simple. I don't care how much money you make. I don't care if you make $1,000 a month, $10,000 a month, $100,000. It doesn't matter. When we start talking about housing, in my perfect world, I don't want you to spend more than 28% of your income on housing. So it doesn't matter how much you make. We still have a guideline on what you can do there. And as we go through this, you're going to go 28%. Well, that doesn't sound like much, but that's because you've got so many other expenses that you need to cover. So for a couple of examples, let's just go to the one that's kind of towards the middle. Let's say you make $7,000 a month, because begin. This is just an option. This is an example. So if I was making $700,000 a month, I would not want to spend more than $1,960 a month on housing. And I can already tell you that many of you are going to be looking at this going, oh, no, I'm going to spend much more on that. In some areas, because the housing costs are higher, you may need to do that, but you're going to see that we're going to have to dramatically cut back on what you spend on any type of installment loans and also on credit card payments, because you cannot always have it all. And the reason that I suggest that you try to stay within 28% is because all of the things you see at the bottom of that slide. Why only 28%? Well, if you are a W-2 employee, we already know that another 7.65% in Social Security taxes are coming out. That's not optional, that's mandatory. If you are self-employed, well, you have to pay both your half, which is 7.65 as an individual, and you've got to pay the 7.65, which is the portion as an employer, because you're acting as both. Well, that's another 15.3% off of your income. Now let's look at your regular income taxes. Most of us pay those. Anybody else paying income taxes? Well, depending upon what you earn, and these brackets are graduated, you could be paying an additional 10% to 37% of your income in income taxes that's gone. Now let's talk about state income taxes. Many of you live in states where you pay income taxes, and I estimate those could be another 3 to 10% of your income. Do you have installment debts, student loans, car loans, child care? Once we start adding all of these additional numbers up, and many of them are not optional, whereas your housing costs are optional, you get to choose in many cases what those can be. That's why I really work at trying to get people to align your finances to where you're trying to spend no more than 28% on your housing expenses. Is that making sense for that? And again, I don't care how much money you earn. This is just a guideline that you can use whether you get a raise or not, or even a drop in pay. And another thing I want to look at is some of the hidden costs of home ownership that most people really forget about. How long are you going to stay in that house? Because I've talked to many of my clients, well, this is a starter home. I'm going to stay in this one for maybe 5 to 7 years. Well, there's a hidden cost in that decision that you want to be looking at. The first thing that I look at when you're looking at home acquisition costs, I really encourage people to set aside 10% for what I would call an acquisition cost just to get moved in. Maybe you need to do a few minor repairs. Maybe you need to add furniture. Maybe you need to do a little bit of landscaping. I don't know, but moving is not free. There's always utility deposits unless you're totally off the grid, and several things that go along with it. And I find 10%, it's a good number, may vary a little bit. And then you also need to set aside 10% of the home value when you sell it, because in most cases, you're going to have to pay for title insurance. You're going to be paying for a real estate agent commission. You might be having to pay for a termite inspection. Whatever the case is, selling a house isn't free either. So if I look in my example and I say that we're going to sell this house in 5 to 7 years, and I took out a $400,000 number, yours may be higher, yours may be lower. It's a number we can work with. And so 400,000 times 10% would be $40,000 that I would expect to pay in selling costs. That could be my equity. That's money I bring to the table, but it's $40,000 of my real money. Now, if I took that $40,000 additional selling expense and I'm going to sell the house in 5 years, I've just added an additional $666 a month to my carrying costs for this house that are over and above the payment. So are you grasping this? Now, if I decide that I'm going to sell it in 7 years, it's a little smaller at $476, but that's still almost $500 more a month. That is a hidden housing cost, but I'm going to be paying it, whether I set this money aside every month in a separate account or I do it at the closing table. And there are cases where you need to bring money to the closing table. I've never seen a contract that guarantees that your house is going to appreciate when you sell it, not in the sales contract. So this is a hidden cost of the housing I want you to think about. So now if I use this $400,000 home example and I have a 4% loan, so I assumed you put 20% down so you don't have to pay private mortgage insurance to keep the payment a little lower. We've got the principal and interest of 1528. I estimated insurance because you're going to need to have insurance on the home because you've got a mortgage on the home and you want to protect that investment. You're likely going to be paying some type of property taxes. I chose 1.5%. Yours may be more, yours may be less. Normal repairs and maintenance. This is another area I see people miss on their housing. Houses are like a big kit. You will never finish. You're going to have to fix the gutters. The garbage disposal died. It's time for a new refrigerator. We've got to upgrade the bathroom. Something is going to happen. And I usually say set aside somewhere between 3 to 5% of the home value just for routine maintenance in a separate account. Now, there are years when you're not going to use much of this money, but then there's the big year where you've got to replace the AC and heating system. You have to do updating on carpeting. You've got to repair the roofs. I live in the Virgin Islands in the Caribbean. We have to deal with cisterns. So there are things that are going to occur. In my example, I said normal repairs and maintenance at 3% of value. I took 400,000 times 3%, which would be $12,000 a year. So that added $1,000 to what my carrying cost on this home, because if I don't maintain it, I'm also going to lose the value. And the longer I don't maintain it, the more expensive the repairs will be. And then when I add in those selling costs estimated in 5 years, I'm now up to $4,195. And the amount of my housing payment pales in comparison to where it's almost double because of those repairs and maintenance costs and my future selling costs that I never built into the equation. Now, in addition to that, unless again, you're off the grid, you're probably going to have an electrical cost. Maybe you've got a propane or gas. You have an alarm system, cable, bug spraying, homeowners association dues, condo fees. All of those things can dramatically change what your costs are on housing. But when you're doing these piecemeal, you aren't always looking at the big equation. So for any of those, has this been an eye opener for anybody? When you're looking at this and if you've experienced this isn't something that you've thought of before. So this is a revelation for some. Here's another revelation I want to get to you about keeping more of your own money. I get the question all the time. Well, should I do a 15-year or a 30-year payment? Because the 30-year payment is so much lower. Well, let's look at it. Let's go to that same $400,000 house and let's pretend that the rate is 4%, whether I do a 15-year mortgage or I do a 30-year mortgage. But of course, the biggest difference is 15 years of payments. Well, if I take this $400,000 home and I look at my 15-year mortgage payment is $2,959 over the course of 15 years, I'll spend just over $532,000 on my $400,000 home. So folks, if you had appreciation or anything, I can tell you, you really have paid for it in the interest. Now look at the 30-year loan. Yes, it is almost $1,000 a month cheaper, but you're going to make those payments for an additional 15 years. And many of you will do the 30-year loan because if you don't do the 30-year loan, you cannot afford the house. Now, in that case, it is $687,000 you're going to pay if you kept it for the 30 years for the same $400,000. And if you go, oh, well, Amy, that doesn't matter because I'm not going to stay there 30 years anywhere. If you keep bumping houses every 5 to 7 years, somewhere in this equation, you're going to be spending 30 years or more paying off mortgages. So I want you to understand that the longer you stretch these mortgages out, you are paying a premium. And in this case, you can see it's almost 40% more for the exact same house. So are you seeing how these costs of ownership can be very different than what you may have been focusing on just the payment before? Let's talk about the 33% rule. For every $1,000 of income, no more than 5% or $50 in installment debt. And some of you are going to about fall out of your chair because you are making $400 or $500 a month car payments. Some of you a little less, some a little more. And if you're overspending on housing, you may have to reduce the spending that you're spending on any type of installment debts. These could be credit cards. They could be braces so your children have beautiful smiles. They could be medical bills that you have to overcome. They could be student loans. And I have an awful lot of clients that we have completely refocused on their situations on those student loans, which are extremely expensive. And we have delayed home ownership. We have lived in much smaller accommodations to get rid of those student loans as quickly as possible within about 3 to 7 years, so that you will not be burdened with that for the next 20, 30 years of your life. Refinancing doesn't make them go away. So this is something that can affect your ability to even be able to afford housing. And I know you want it, but at the same time, what do you want for some of the longer term goals? Then there's the 36% rule. For every $1,000 of income, no more than 3% on transportation. Wow, that's going to hurt. So when we're looking at your transportation costs, that is something that depending upon where you're residing, you're going to be using public transportation or you're going to be using your own transportation. I know that doesn't sound like a lot, but I'm going to go back to, for many of you, depending upon your income, you may not be able to afford a bigger house and afford a lot of student loans and afford a big car payment when you've got these expenses. And it goes right back to what we talked about early on. We've got Social Security taxes and income taxes and state income taxes and all of those other things on top of it. And by using these percentages that I'm suggesting to you, it can make your lifestyle maybe a little more modest than somebody who has a similar income. But that is a choice. And I'd like to keep you off the cliff of bankruptcy and stress. And this is one of the proven ways that we've been able to do this for clients, to enable you to have the funds to do some of the other things you need to do as a part of adulting, that we work with. All right. What's the 40% rule? I've thrown you another number. We did 28 on housing, 33, 36, 40. No, it's not a football play. So for every $1,000 of income, I don't want you to have more than 40% on your fixed expenses. So whether you have a combination of housing, installment debts, transportation costs, whatever, that's really the threshold. And that's a high threshold, because at 40%, you're going to affect your ability to get any type of loans because you are at the overextended point. And on that 40, again, I'm going to go back to Social Security, income taxes. And if we took 40% and I said that you're an entrepreneur, we've got 15% on it. That's 55% of your income that's committed before it comes in the door. Let's say that your income taxes are 20%. It's just a number. You're now at 70% is committed before it comes in the door. Now let's talk about, you've got state income taxes. Let's make them 3. That's 73%. That only leaves 27% for your groceries, your insurance, your medical expenses. Do you ever want to take a vacation or buy clothing? School expenses, those type of things. So hopefully these numbers will help you. So how do we stretch the money? Is anybody interested in stretching the amount of money that you have to work with? Well, let's figure out some ways to make more out of what we've got to not reduce your lifestyle any further. How many of you know that by paying your insurance on an annual basis, work it out, that put it away a little bit each month, whatever it takes, that you can save between 3 and 8% off of your insurance premiums? Some of you will pay it monthly. And if you look closely, there's going to be a monthly service fee, or there is a higher multiple. If you take what you pay monthly times 12 versus paying it annually, you could save 3 to 8%. And you're going to go, well, Amy, that doesn't sound like a lot. All right. Round number. Let's pretend you're spending $5,000 a year in insurance. And I really don't care what kind it is. And we can pay it annually. Well, 5 times 3 is I could pay $150 less if I pay it annually versus monthly for the exact same coverage. Now, what if I have an 8% savings? That's $400 worth of savings. What is that $400 hypothetically times 10 years? That's $4,000 more that you keep in your pocket instead of giving it away in an extra insurance premium. Do you see how these numbers can start to really add up and makes a difference in your financial world? There are some services that if you prepay them for a year, you get a couple of months free. All right. What's a couple of months worth? Maybe it's on your trash. Maybe it is on any type of an internet service. It is a subscription. Whatever the case may be, whenever you can pay it annually and you can get the perk of getting 1 or 2 months free, every month you get as a discount is like a month free is like an 8% discount. So 2 months free would be like a 16% discount. Stretch it, make that money go a little bit further. Set up an ongoing search on eBay or other sites to get the lowest pricing on certain items. They're out there, Amazon and different ones, and time some of your buying to make your money go the furthest. Let me give you another one. This is what we do in our house. Here, not too long back, before a lot of things went up again, prices rise for me too. They had boneless, skinless chicken breasts for $1.99 a pound. I walked up to that counter and I looked at that and I went, wow, and I have a freezer. I took every package of $1.99 a pound boneless, skinless chicken breasts that they had out and felt no guilt because it was for sale. I did share one with the lady who was looking at it and told her take what she wanted. But I came home with it and I happened to know that within a week, the price was going back up to $3.99 a pound. I have it in the freezer, and when I take it out, it's the exact same tasting chicken, but that allowed me to dramatically reduce the cost of it almost in half. Again, everywhere you can, look at ways that by doing and buying a little smarter, that you can extend your resources in your lifestyle to have additional funds to do other things that you want to do. Let's talk a little bit about cell phone fees, texting, soft drink, nails, impulse purchases and those type of things. How much do those expenditures really cost you? Now, one of the tips that I have for everybody is every 6 months, I want you to put a note in your calendar. I want you to call your cell phone carrier, and I don't care who it is, and ask them to look at your usage and what is a better plan that is out there. I do this every 6 months and I continuously drop it. I don't care if I drop the cost of the bill $10 a month. That's $120 to me for the same cell service. It is $1,200 over the next 10 years that I would rather keep the cost of a phone call. So let's talk about one, for example. Now, this was from a real client that paid cash for a lot of things, but could not figure out where the money was going from, and discovered that this particular person likes to buy a lot of soft drinks. And in doing this, I chose this as one of our examples. So we're going to do some math. And if you want to grab your cell phone and do this yourself, pick an activity that you might be doing. Well, we have a choice. We decided we were going to do something a little bit different in this case. They had been spending $1.25. Some of them were $2 because they bought them out of the machine at work. They stopped by the gas station on the way to or from work, and they were spending much more than this. This was up to like $2,500 a year on what they were spending on soft drinks when we really kept a record of it. But they were such small purchases, but several a day, that it really added up. So if we changed our dynamics a little bit, and now we go down and we're looking at picking up the soda at $5.99 on sale for a 24 case. All right. So the keyword was on sale. They're going to buy multiples of them at that point. So if you drank 5 cans a day all year long, that's 1,825 cans, 76 cases. So it's $455 a year. Now, the next question you could ask yourself is, let's take a net hypothetical take home. After you've taken all the deductions out, let's say hypothetically you are netting $15 an hour after your Social Security, your Medicare, your income taxes. Maybe you have got payroll deductions for health insurance and other things. So we're just going to pick this number of $15 an hour. So at $15 an hour, that is 30.3 hours that I have to work, hypothetically, in order to pay for my Coke for a year if I'm buying it on sale. So pick a week a year from Monday until late Thursday out of a 40-hour week, and that's what you're going to do in order to have 5 cans of soda a day. Now, if you are a family of 4 and this is a common drinking habit for you and you don't think about it, so now you have jumped up to you're going to be working almost 4 weeks a year just to pay for soda. Pick something, decide if it's worth it to you or not. And if it's not, then decide what you're going to change. Maybe you decide to change to only 2 a day. Maybe you decide you're only going to do it on weekends. I don't know. But when you start looking at some of these particular purchases, I think many of you are going to be amazed at how much of your income is going to a few items that maybe they're not worth it to you. I don't know. So we're just going to throw some ideas out here. One of the things I have found that is an excellent tool is called an irregular expense account. Now, on an irregular expense account, we set this up in a completely separate account, a separate checking account or whatever. And what we're going to do is we're going to figure out a pretty good guesstimate of what we spend throughout the year on things that don't happen every month, like Christmas, vacations, your car repairs. What about your co-pays and your deductibles or your prescription cost? Clothing, school pictures, any of those things that don't happen every month. And let's say hypothetically that we go through and we're working on those. And this is one of the resources that I have. It's something that if you shoot me an email, and I'll put a few things up towards the end that I'd be happy to share with you. It's a worksheet where we work through all the different things that you'd use throughout the year and then come up with a number. And let's pretend that hypothetically, I figure out that over a course of a year, I spend $12,000 on all these miscellaneous items. And if I was converting my insurance to paying it annually, I might throw that figure in here too. Separate account. That way, when you think you have extra money in a checking account, when you really don't, because maybe the car insurance is coming due in a few months, I take this number and I usually multiply it by 1.1 or maybe 1.3. So we've got a little bit of padding. If you can, you want to jumpstart the account with about 2 to 3 months worth and start using it immediately. And over the course of a year, you'll be able to see if you have accurately judged some of your expenses or not based on the balances. And for those of you, if you take a minute and look at my picture here, because I'm talking to you. So look at my picture. When you put money into your regular account from your earnings or for an irregular expense account, it's like the tides. When you add money, the water level is up here, like the tide coming in. And then as you pay your expenses, it comes back down. So this account value is going to go up and down a lot. But over time, this keeps you from putting items on your credit card when you spent money that you really didn't have. It helps you be able to pay for the vacations and those things that are important to you to help you stay within your means, again, to keep you off of that bankruptcy or that there's never enough money crisis. That's one of the goals that I have. So are you finding that helpful to have a completely separate irregular expense account? Because again, this is something that helps you financially, lets you see where you are. Now, for some of you, you have gotten into a habit that in order to control your expenses, you pay cash only, but it's also costing you money to do that. Remember, we talked about the soft drink example, where because they were little purchases here and there, until we really wrote down everything that was spent, didn't realize how much of the resources, thousands of dollars a year, were going towards soft drinks, just out of convenience. Well, you won't have a credit history. And without a credit history, when you're ready to borrow, that's going to be a problem because you will not be a qualified buyer. There's no history. You may be a high risk. Therefore, you're going to pay higher interest rates or be denied. It's also very hard to track expenses. But more importantly, you're missing out on the perks. And the perks are what I want you to have. So when we talk about your credit score, we're going to spend a minute. This is something that I joke about. This is part of the Secret Squirrel Society. They don't tell you exactly what they do to put the score together, but they give you some ideas. These are the numbers that lenders or credit card companies, sometimes landlords, if you sign off on that release, will look at to determine whether you are a good and responsible person with your resources. The further overextended you become, the lower your score drops based on income. And there's a lot of different components. Are you paying your bills on time? But if I am a lender, and let's pretend I have 3 applications on my desk today, and I'm looking at these 3 credit scores, 515, I'm probably not going to loan them money without a cosigner that has a good credit score. 621 may be iffy. Are they coming out of a divorce? And after that, they've done well, but I'm going to have to evaluate. 753 probably is not going to be a problem. And the person with that 753, whatever offer they put across the table, should also ask them, well, based on my score, can you do anything just a little bit better than that and shop around to get the lowest rate? The worst they can tell you is no. The best they can tell you is, well, I can shave another, 0.5% off of this. And you say, absolutely, because that puts more money into your pocket. It doesn't hurt to ask when you've got a good credit score to bring down any of those borrowing costs that you are choosing to pay. So let's talk about, does it really matter when it comes to cash back on perks? And I'm going to say yes, because some of you are using a credit card that has no perks, or you haven't been doing this. You've been using a debit card, which does nothing for you. If you get into a card and you can do a search on the internet where they'll give you 1%, some of them are 2%, some of them have 3% in a category that you get to choose. Some of them have 5% in a category that you choose. You might get additional perks if you get a card with airline miles. So with the miles, I have that one. Anybody got an airline miles card? I do, and I absolutely love it because, I do travel on airplanes. And when I travel, my first check bag is free. That's worth $35 to $50, depending upon where I'm flying from, one way and back. So just having that card is worth at least $70 to $100 every time I fly. And if I book up to 4 tickets on the same reservation, each one of those individuals get free bags. Again, I get to keep more of my money. They also have multiplier programs. Sometimes you have free rental car coverage. I know that's worth probably $10 to $15 a day, depending upon how long you rent the car. So let's look at another idea here. And just being hypothetical, some of you are not watching. I have dealt with clients where we really dug into it. I want to see your bank statements. I want to see these things, and let's find where some of this missing money is. Found an individual that they did not realize they had an old account. They hadn't updated in a long time. Once they got over the point that they had done 10 debit card purchases in a month, they got a 50-cent debit card charge. But you know what? They never balanced their bank account. They just always kind of looked at the statement and saw what the balance was and went on, and never bothered to go far enough to look and see what the fees were. So in their case, we had a 50-cent debit charge 10 times a week, because remember, they were trying to be really good with their money. So they used a debit card instead of a credit card. And so they weren't getting any perks or anything else and didn't want a big credit card bill. So 50-cent debit card charge 10 times a week, 52 weeks a year. And this is on average. So they were spending $260 to use that little piece of plastic because they didn't want to use a credit card. Now, I got them to switch over, and we had about $2,000 a month in spending instead of on the debit card. Money's still there to pay for the credit card bill when it comes in. And now instead, they're getting $480 a year in cash back. So the two things that they were leaving behind were $740 a year. And again, I want you to think about it. Take it times 10. Is there anybody here in this scenario that you could do something with $7,400 more in your pocket over the next 10 years, or even $740 over this coming year? But you got to pay on time to make this work. If you don't know and you're not sure how to do it, then reach out, get somebody to help you a little bit. But this is money you could be leaving behind. Do the airline miles really matter? I mean, I use two cards. A lot of people do. Some things they put on airline miles, some things they put on the cash back. Well, here's an example, and this is one of them that was from a ticket that I bought not too long ago. So if I needed 12,500 miles was required, I could pay cash for the one-way ticket, and it would be, $543. Or I could take that 543 divided by the airline miles, and I discovered that those airline miles were worth 4.3 cents each. I went ahead and used my airline miles, because if I was to buy, in the second example, a one-way ticket using the same 12,500 miles, it's not a good deal for me, because I'd only get 2 cents a mile on my cash back card. So I can pick and choose where I can make the most money between my airline miles and my cash back cards. So that's a little something that if you're not doing, you should. Some of you are terrified and you say, Amy, I cannot afford a great big credit card bill. If I got a $2,000 credit card bill, I would just about wet my pants. No, you won't. Because I want you to understand that if you quit using a debit card and you use a credit card and you're doing the same purchases you were doing before, what happens is, let's pretend that you bought the item January 1st. The statement closed on January 25th, and the bill is due on February 23rd. That money is sitting in your checking account and it is accruing until you make one installment and pay the credit card bill. So as long as you don't go stupid with your spending, this is not going to be a problem. And you want to make sure and you EFT or you write the check before the due date. When I have clients that I've converted over to this, what I make them do is to promise me the day the bill comes in, you set up the EFT or you write the check so that it is always paid before the due date, which will help your credit score. And we never pay interest on that account. Easy to do. The money is in the account to take care of it. For some of you, you are already into the deep, dark debt hole. You're listening to me and going, Amy, but I cannot get out of debt. All right. Well, then we need to do a 3 to 7 year plan and we'll get you out of debt. Now, the reason that this usually takes 3 to 7 years is I've got to retrain you. You're used to taking any extra money you get, whether it is a tax refund because you're having too much money withheld, and that's a different topic that we should fix. And that's part of the reason that you're going into credit, or you really haven't been tracking your expenses and you need some help. The reason you can't get out of this debt hole is you've got credit card balances that haven't been there for a year or 2 years, 3 years, 4 years. Is that when I look at your credit card statements, depending upon what interest rate you're paying not, you bought $1 worth of something, but you didn't pay it off in the first year. So you paid $1 plus 15 cents up to 30 cents in interest. So you paid $1.30, but you haven't even paid it yet. And then next year, you haven't paid it off yet. And so you pay another 15 cents to 30 cents. And every year after that, that dollar never gets paid for. So you reach a point that instead of paying $1 for anything, you're paying $1.90 because it took you 3 years. You're paying $2.10. You can never get over that when you're not paying $1 for $1's worth of goods. And I want that to sink in. If I can train you, whenever you have an increase, whether it's a salary increase, I don't care if you do a garage sale or sell stuff on Facebook, you get a little bit of a windfall to put half of the money towards the outstanding debt, and we're going to go to the highest interest rate to get rid of it, and half of the money over into a savings account, or remember that irregular expense account. Then the next time we have an issue and we need something, the car repair that you used to put on the credit card, the office visit to the doctor that you put on the credit card that you could pay, we're going to pay those, and we're only going to pay $1 for it. And this can take you 3 to 7 years. But at the end of 3 to 7 years, we have filled up that deep, dark debt hole. And it is no longer an issue because we've got you out of the trap. Because otherwise, what happens if I can't train you to do this and be consistent about it, about the time that you're going to see about this lip level where my cursor is, something is going to happen. I don't care what it is, it's going to happen. And you are going to go down. And the only thing you can do if you have no money in savings is take the money out of the credit card, and you're going to start over at the bottom of this hole over and over again. And you know I'm right. If I'm right and you have done this, or you see people doing this, raise your hand. Now, those of you who are parents, listen to me. I'm a parent and I'm going to be real strict here, or a sibling. Do not bail anyone out unless we fix the underlying problem, which is the management of resources. Because if you bail them out and you pay all of the expenses, you pay all the credit cards and everything else, and we haven't found the root and fixed the reason why they keep going in debt, you will come back to the table and you will do it over and over again. Do not bail someone out unless you have rearranged the resources to make sure that they can make it. I'm just trying to help. Now, some of you are going to get offers. Now, I purposely made this slide where you're going to see these are offers from 2019. And you think I'm using old data. I am, and there's a reason. I discovered when I've done these training seminars and things live before that when I put offers up, I get umpteen. Who is that? How do I get that? How do I get a hold of it? I want you to quit focusing on that because all of you are individual and you have different institutions you're working with, or you can go online and find out what the most recent offers are, but you want to check your credit scores to know if you're going to be eligible to do some of these balance transfers and the offers that are available. If you don't know how to interpret these, I've got tools for that too. That is a real easy little worksheet that you can go through and you can put the information in. And even if you have to pay a fee, you know, a 3% fee, a 199.5, but you have a 0% or a 199, and this is going to go for 12 months. There are ways that you can go through really quick to determine what your savings are going to be over that time frame when you move the balances. Then in addition to that, we put a note in the calendar that is about 6 weeks to 2 months before the expiration date of this offer. And we'd go for another balance transfer offer to get rid of this interest. So let me give you an example. And if you can write this down or type it in your phone. Hypothetically, you got $10,000 in credit card debt. Hypothetically, you're paying 25%. That is $2,500 a year in interest this year, assuming that you paid it off, but you didn't. If I could move that $10,000 to a different credit card, let's say they charged me 3%. I have to pay a $300 balance transfer fee. Woo-hoo. I have 0% interest for the next year. And after that next year, the rate drops down to $1,599. Well, in year one, I have saved the difference between the $2,500 minus the $300 balance transfer fee. That's $2,200 in interest. Now in year two, if I have not gotten the rest of the balance paid off, I have dropped my interest rate by 9%. If I can find another balance transfer, then I do this over and over again, which will speed up the 3 to 7 year cycle to get you out of debt. All right. So it's resources. Let's talk about small changes on your savings. Yes, I know the rates change constantly. We have all been living in an environment where most of them start with a 0 point, which makes it a positive number, even though if it's a tiny positive number. How many of you have seen the 0 point numbers? We all have on our checking or savings or some of the money markets that you have. Now on a $10,000 deposit, you might be earning woohoo, $10 a year. But if you looked around a little bit and you placed it where it was at 2.1%, you're going, that doesn't make that much difference. Well, that's $200 more. What have I taught you about times 10? What's 200 times 10 years? That's $2,000. Can you do anything more with $2,000? Once you start building up the balances, this becomes a much higher rate of return. So on $50,000, just to have it safe, maybe in your local bank or somewhere else that, it's a relationship. Well, is the relationship worth $1,000 a year to you? Because exactly, that's what you're giving up and more. Look at these kind of things. What about some of these minor changes that I've been talking to you about, where if you carve out just a little bit or you haven't been consistent in savings, don't start out big, start out small. You pay off a bill, put it in savings, or say, I'm going to do $5 a week. I'm going to come up with some way I'm going to save a little bit. Hypothetically, and again, the rates you get may be higher or lower. I'm just looking at an average to make you think. If you took $25 a month and you were earning on average 5%, maybe you're using mutual funds. Maybe this is in your payroll deduct savings plan. In 5 years, you've got almost $17,000. In 40 years, it's $37,000. If I tried to ask you to give me $37 right now, you can't do it. Can you do 25 a month? Probably. So I want you to also understand what the difference in the compounding and things do for you. Let's go down and we're going to take this hypothetical last one. You spent $250 a month and you committed to it and you were faithful about it at 5%. At the end of 40 years, you have over $370,000 in this account. $370,000. You might not have that now. But did it cost you $370,000? And the answer is no. And I'm not even talking about tax liabilities. I'm just going to talk about accumulation right now. Because all it cost you was $250 a month for 40 years. So it cost you $120,000 to have 370. A little change can make a lot of difference. I'm going to spend a minute here. And again, you're going to notice I have picked up an old chart. I have done the old chart because I don't want you to look at this and run right out and think it's your answer. I want you to talk to a professional or do your research. This happens to be a mutual fund. This was from a Morningstar report. Now, mutual funds are, you buy a mutual fund and you are a share or an owner with a lot of other people, and you have a professional who is managing it. With that, you're going to see that this little graph here shows me there's a red line, and that is the performance of that investment. There is a category average. That's everybody else who's doing the same thing, essentially by their description. And then we have got the standard index that has been put together to see what's working. Now, on this particular investment, you're going to notice that this really is pretty consistent. Over this 10-year period, it did not fluctuate. It did fluctuate a little bit from here to here. So I looked at how long did it take for this to recover from that particular drop. And if we look at the calendar and say, well, that's probably the third quarter of 2008, that was about midway in 2009. So I'd be really comfortable saying this investment may be a year. Now, if you look at the investments you're considering, of course, you're going to see a chart that is the current 2011 to 2021. But we're just using this for a discussion point. That's all it is. Now, if I go down and I look at this total return percentages, you're going to notice it tells me how it varies a little bit year to year on what the performance has been. So even though we had this little bit of a drop right in here, it still ended up having a little bit of a positive return. But wow, it came back quite a lot, but that was mainly because of the drop that we had here. So if I was wanting something and I'm trying to talk to my professional with my investments, and I really was adverse to risk, but I wanted to have a little more or a little better on my earnings, then I might want to have some discussions to help me understand what is normal for my investment. What it did over the last 10 years is not a guarantee of what it's going to do over the next 10 years. But at least it gives you an idea and some discussion points so you don't have any surprises. Let's look at another one. The same thing. Oh my gosh, most of you are able to see the red and to notice what the red does going down. Now, I want you to understand that depending upon how I tell you the story, you're going to have a very different concept of this investment. Let's go right down here. And if I told you that, well, it was up 50% last year, you're going to jump all over that and go, wow, that sounds incredible. Or if I told you, oh, this was up 85% in the last year, you're going to have an impression, but that is not the total picture. If you look at this investment, it was up 50%, but then it was what? Down 63. It was down 25, down 2, down 27. Well, heck yes, it could go up 85%, but did it really matter because it had gone down for so long? Minus 66, all of these types of things. So if I go back up here and look at our arrows, so here was a high point. It dropped 63%. It recovered. Okay, that was about a year. But now let's look at the next time that it was about the same. We had dropped, but here we are. We're right between 2003 and 2004 in this example. And because of all the gyrations, and even though we had that 1 year that we were up 85%, woohoo, we were now just about even with where we were clear back here. How long is that? 1, 2, 3, 4, 5 years. If you are not that kind of a risk taker, where if your investment fell and it could go downhill, or it may take 5 years to get you back to even, it may not be the right one for you, but you have to have these discussions. Here's another one, a little bit different. If we go back, and now I want you to focus down here where my cursor is on that blue line. So if I look at 2004 in this dated example, ooh, this is the story that I'm telling you. It was up 19%. Then it was almost 10% the next year. And you know, the third year, almost 15. The fourth year, over 10. Can you believe it? You can believe it, but what's the rest of the story? The rest of the story was on this was after this had went up. Do you see the significant drop in the account? So if I look for some little wiggles on this one, all right, we had a little bit of drop up and down. So in this about a year, but now let's look at this again. So I started here in mid 2007. I was back to where I started for in about mid 2008. And I was back where I started from. And now I'm in the early part of 2011. So 1, 2, 3, 4 years, and I'm about even. I may not be willing to take that kind of a risk, or some of you will set on things. There is nothing wrong with taking a profit and moving on. If you see, perhaps with talking with your professional, that you have investments that are cyclic, where they may go up for a period of time, sell it at the top, go find something else. You do not have to buy something and hold it forever. That's really a choice that you have, but talk to your professionals or do some of your research. We're going to go into a quick lesson on life insurance. Let me be blunt. When somebody dies and death occurs, who usually brings the biggest check into the household? It's the insurance company. It's the life insurance. Do most families need that life insurance? How many of you say yes? You got to have insurance. This is not, a big surprise. Who usually brings the biggest checks when you have a health issue? It's the insurance companies. That's why you have the insurance, is you can absorb little losses. You can pay a copay. You can pay a deductible. You cannot pay a $400,000 hospital bill. You want to insure for the things that you can't write a check for. So some common uses of life insurance, most people say, oh, I need enough to bury me. Well, that's costing more and more all the time. But what about the future living expenses for the survivors or the people who count on you? And even though some of you are single, if you are assisting parents or grandparents financially and they are depending on you, And you say, well, I don't have any dependents. Well, if someone is depending on you for financial means or assistance, you probably have a need for life insurance. You may need to replace your wages. Some of you are paying for private school tuition. You've got kids in college that you've got to take care of. Do you have credit cards or mortgages you want to pay off? You know, you can't pass a car or a house to someone if it still has a mortgage on that has to be paid. They either have to pay the mortgage or the car loan off, or they have to sell the asset in order to pay it off. So if it is your intent to pass those assets on, we probably need life insurance. So we need to talk on life insurance about ownership, because I would like you to be able to avoid the unholy triangle. Most of you have never heard this concept before. So life insurance is tax-free as long as you structure it correctly. Remember that adulting thing? I don't care how old you are. Most of you have never had this conversation based on the clients that I have worked with across from my table or on my Zoom meetings. In order to have tax-free benefits on a life insurance policy, we just need to have 2 points of the triangle match. Very simple. I can have the insured be the owner of the life insurance policy, and that is very, very common. And then they are in control and they name the beneficiary. Simple. I could also have the beneficiary be the owner of the policy on the insured, because 2 points of the triangle still match. There is 2 points of the triangle that can absolutely never happen. If you are the insured and I'll be the insured and I die, I cannot be the beneficiary of my life insurance proceeds. I'm dead. It doesn't work. Don't mess up. And if you say, well, I've named my estate, your estate is not you. That could work, but it's not the most efficient way. If you violate this and you have 3 different entities or people on the points of the triangle, whoever is the owner of the policy has created a tax bill for themselves. Let that sink in. For the amount of the policy that they gave away to someone else. Let's pretend it's a $500,000 policy. I created a tax bill for me on $500,000 I gave away to my grandparents or my grandchildren perhaps, and I have to pay the tax bill, but I didn't get any of the money. Talk to your tax preparers. You don't want to have this happen. So I'm trying to help you adult into a different conversation. And I want you to check your beneficiaries. You must name them. You have a primary and a contingent. A primary just means first. And when we start talking about a primary beneficiary, when I die, who do I want to receive the proceeds first? This can also be the same for your IRAs, 401ks, those type of things. If that person dies before I do, or maybe we're in the car at the exact same time, who do I want as my contingent beneficiaries? I want you to pull your stuff, make sure it's on there. You cannot believe the number of work policies that I find and life insurance policies where whatever happened, the paperwork never got filed. They do not have a contingent beneficiary. And I find a lot of them that have never updated a primary beneficiary. There was one here several years back that was called the Million-Dollar Pickle. A woman worked for a company for 40 years. On her life insurance, she had listed, I believe it was her sister as the beneficiary. She got married. She never changed the name to her husband. She died. He thought he was going to get her company life insurance. No, no, no. Her sister got it because her sister was named as the beneficiary. They tried suing. The argument was this woman had gone to work every day for umpteen years. At any point in her life, she could have changed the beneficiary to her husband. She didn't choose to do that. Don't make stupid mistakes. I've also seen policies that they've been remarried for 10 years. And I pull out all the documents and somebody is squirming and somebody is being glared at. You have not changed this. This still has your ex's name on it. You're going to change that paper now in front of me. Don't let these kind of stupid things happen. And if you don't have a beneficiary, it will pay into your estate. This is a bad idea. If my life insurance, hypothetical 500,000 paid into my estate, first thing that's going to happen is my attorney, who is probating and assisting with that, collects a 5 to 7% fee on average. So $25,000 to $35,000 of that money is going to go to compensate the attorney for managing the $500,000 of life insurance. All of that money is subject to creditor claims. So if I have any outstanding bills, credit cards, you name it, everything is going to come out of that before any of the beneficiaries of my estate ever receive a dime. So let's make sure those are fixed. Well, why do I need legal documents? Remember? And this one is going to be quick. I'm not going to be able to hear you, so I'm going to throw a couple of answers out. But if you want to type them in the box, please do. Can you describe eggshell to me? You hear the word eggshell. What is eggshell? Just say it out loud. There's nobody around. What is eggshell? Can you think of anything else eggshell is? What is eggshell? You're going, Amy, why are you asking this question? This doesn't seem to have anything to do with legal documents. That's because I love this next slide. This is a really cute cartoon. I love it because it illustrates exactly the legal documents and account titling and all of the things that I work with clients that are messed up. This isn't exactly what I had in mind when I asked you to paint the walls eggshell. I get the idea she probably was looking for a nice, soft, off-white color, but this is not the result she got because the language she was using and her understanding was completely different from the language he understood and what he heard. This is what is happening with many of you on your legal documents, your titling of your bank accounts, your investments, and everything else. So we want to avoid that. There is a completely different session that I do on account titling that I go over joint trust with rights of survivorship. What about a living trust? POD stands for pay on death. Most of you are not doing this, and you are automatically setting up your accounts so that they will pay into the estate needlessly and be subject to all those probate costs and creditor claims. We could eliminate it and have it go directly to your beneficiaries. We have individual accounts. We have tenants in common. We have transfer on death. Again, these are free things. You fill out a piece of paper. It's easy. It's done. Do you have digital assets? This is really what I will call some of the modern age. Some of you have got wills or documents that are 20 or 25 years old. You don't address any of these things. Are you doing anything with cryptocurrencies? What about Facebook? Some of you have built businesses that involve Facebook and Pinterest and Twitter and websites. You've got domain names. Who is going to take possession of those? If you're incapacitated or you pass away, let me give you Facebook, for example. There are mechanisms that you can put in place that someone can go in and they could close down your account. Some families want that. They do not want that staying up. Others would want to maintain it because maybe you have a business related to it, but nobody has permission to do it. And you know those pages and pages that you signed or you just clicked the box and you agreed to? The terms are already there, but you need to get something appointed on that, especially if these are significant assets, to make any type of a transition or a maintenance very, very quick and rapid. What is a will? A will simply passes out your stuff. Whatever your stuff is. Is it the most efficient way to pass out your stuff? The answer is no, in my opinion, because we have other things like POD, TOD, we have trusts, we have things that we can make it private. It doesn't have to be probated. It doesn't have to be expensive. But each of you are unique, but you should have at least a basic one. Now, I want you to look at this. This is a true Facebook post. I have removed the person's name from quite some time back, and I'm going to read it out loud because you need to hear this. This is real. Okay, how much more can one woman take? A month ago, my middle son dies. I have custody of his 4-year-old son, and I'm painfully hearing my grandson tell me how hurt he is because his dad's pregnant girlfriend doesn't care to be a part of his life anymore. And what am I supposed to say? And now St. Francis, her employer, is probably closing and I'll have no job. I'm at the end of my rope and I'm drowning fast. My life is feeling hopeless. It's the worst 2 months of my life. Her son died unexpectedly from a massive asthma attack at home and passed away before any help arrived. You probably guessed he doesn't have any life insurance. No, the mom of the little boy is not in the picture. She has issues of her own. This is a grandmother now who is picking it up, trying to figure out what to do with almost nothing. There is a tiny amount of Social Security. I say tiny because the young man was young. He had gone to school. He doesn't have much on his Social Security report. For many of you who are watching this, if you are grandparents, and I am one, you need to be talking to your children. If they do not have life insurance, you need to consider picking up life insurance. You need to own the policy. They are the insured and you're the beneficiary. So if you are put in a position where you or another family member is going to need to raise these kids in an emergency, I'm telling you, you can't do it for free. You need to have the resource. And if for whatever the reason the parents aren't doing it, goodbye Christmas present, goodbye birthday present. I'm buying life insurance instead to protect the family and to protect the children. And that's a mechanism. That's my soapbox. I'm going to get down, but if you agree with me, say amen. Some common misconceptions. Many of you think that your will is the final and overrides all other legal documents, and that is not true. The will is valid and it is false. It is not the only way that you can pass out assets. Again, some of this is in some other sessions I have about POD, TOD, trusts, transfer on death titles. There are other ways to do it. So don't be fooled that the most expensive route is the only way that you can do this, because I totally disagree. Now, there is, for example, I'll use this in the Virgin Islands. They have real property transfer and they have codes and acts that can include boats. It also can include cars. So there are things you can do in addition to real estate. Boats could also include motorized watercraft such as jet skis. I hope you own a yacht, so that's a problem for you. A couple other ideas we have when we talk about protecting family members and trust. This was a really nice one that I found. I am not broken. I am beautiful. I am different, not less. I am challenged, not challenging. I'm not a burden. I am blessed. Cerebral palsy is not a choice, but acceptance is. Many of us have family members that have developmental disabilities. It could be autism. It could be Asperger's. It could be cerebral palsy. It could be something else. We can also have relatives that have brain injuries from a car accident. Maybe we have an age-related that is dementia or issues from stroke. There are some special things that you can do to protect these individuals and also preserve any public assistance that you're getting. We could do special needs trust. We can do guardianship, conservator, but whoever is the primary caregiver, we've got to build respite plans. These people need a break. And you also need some contingent plans, because what if our primary caregiver is in a car accident and someone has got to step in and take care of this individual? Do they even have a roadmap to do it? Power of attorney. Who has your power of attorney to handle your financial affairs if you are unable to do it, whether it is from incapacity or you just don't want to? What about an irrevocable trust? The word revocable is a key word. It means I can change my mind. You know, I don't have to have one trust. Heck, I could have 37 of them if I wanted to, all doing 37 different things. Now, an irrevocable trust is completely different. It's written in stone. Rarely could you ever change your mind. It's like opening the door and throwing money out, never to be seen again. Once you let go of it into an irrevocable trust, you have indeed let go. There are a lot of excellent applications for it, but it is a very different instrument than a revocable trust. I'm going to talk a minute about cohabitating households. Most of you think that this is a couple that are not married. I don't care what sex they are. In a cohabitating household, whoever you're living with, whatever happens to them, I'm telling you, it happens to you too. So a couple of example could be a grandmother and the grandson is living there while he goes to school. But what happens to his lodging and the arrangement if grandma dies? What about two sisters that are living in the same place? Maybe one owns the house, the other one became a widow and now lives there. If the sister who owns the house dies or decides to move, what type of rights does the other sister have? Maybe you have a mom and an adult daughter. Any of you ever had a roommate? Don't you think you need to know if your roommate cannot make their half of the rent, or if they've got any money set in savings, if you're going to be the only one responsible? Whose name's on the lease? These are things you have got to talk about. And you might have some other arrangement that works for you. So I'm going to go back to my question. Can somebody describe eggshell to me? And we were talking about some of the things that you put in place wasn't exactly what you had in mind when you asked, to paint the walls eggshell. So what I'm going to do now is we're going to go into the question and answer, and I'm going to leave you with a final quote that I like really well. 20 years from now, you will be more disappointed by the things that you didn't do than by the ones you did do. Throw off the bow lines, sail away from the safe harbor, catch the trade winds in your sails, explore, dream, and discover. So let's see if we can go ahead and get my screen back up here to where I am full size, and we're going to stop sharing at this point. And we're going to go over here and let's see. Oh, you have been a quiet group today. I am looking over, and if you have any questions and things, I would like you to go ahead and to put those in the chat, and we will go ahead and cover those. I am going to stop the recording at this point because I like to do my questions live on those. And then this will also go up on YouTube here very shortly. So you'll be able to go back and to revisit